Let's talk about Nvidia. Yesterday, Nvidia was down almost 17%. By market cap, they were down almost $600 billion. I can't tell you how much money that is. All I can do is give you two references. First one, ExxonMobil. $600 million is more than the entire value of the company. Everything that they own, all their oil wells, all their equipment, all the barrels of oil they have around, it's worth more than all of that, gone in one day. Or if you prefer an economic indicator instead, $600 billion is more than the GDP of Sweden. That's a pretty big deal. So let's talk about what happened. Over the weekend, some news came out from a Chinese AI company that they had a new approach for training AI models. Not going to get into it because honestly, I don't know enough to have an opinion. It's that simple. But what the market's takeaway is, or was, is that we might not need as many Nvidia GPUs to train AI models going forward as they had expected. If you look over the last 4 to 5 years, Nvidia has grown up substantially. They've had year-over-year growth of 125%, in the 60s, another year in the 50s. I think they had one year that was like 0.22% out of the last 4, but everything else was just gangbusters. So when they are trading at a super high, relatively high price to earnings multiple, which they have been, I'm going to pull out my handy dandy whiteboard. Even after the fall yesterday, they're still trading at about a 50 price earnings ratio, which means that they're really expensive. And to be able to justify that kind of number, you have to have great growth ahead of you. Because that means the market's actually pricing in that you're going to grow into that multiple. To put it in perspective, if you're looking at the S&P 500, they're more in the 29 range for price earnings multiples. If you're looking at other semiconductors as a sector, they're trading about a 35 multiple. So if you're thinking about price to earnings multiples and how this can affect Nvidia's prices, right now, the earnings per share last October for the fiscal year was $2.54. If you take the 50, it's 49 point something, maybe 74. Price to earnings multiple, that takes you to, as of right now, $126.64 on their actual share price. But if we saw this 50 turn into a 35, and what we would call that is multiple compression. They're still making the exact same amount of money, but the market is saying, you know what? We don't think you're going to grow quite as fast as we did a week ago. So instead of paying 50 times for future earnings, we're going to pay 35. Like I said, that would put them equal with the other semiconductors in the semiconductor index. That would take today's $126 per share price and drop it down to $88 per share. That's a pretty big difference. And we haven't seen that, but essentially that's how the math works, and that's why the market reacted so violently yesterday. Because whenever you're already priced to perfection, think about it if you're driving a car fast, or if you're riding a bicycle down a hill. We were all there as a kid, riding a bike down a hill. You feel like you're out of control. You're over your wheels a little bit. You are just trying to hold on. And at that point, if the smallest little thing happens, you don't have the ability to regain your control. And that's kind of what happens when companies like Nvidia right now have really expanded multiples. They're getting up into the 50s. 50s are a high multiple. The S&P is usually, in the mid-20s. So anytime that a multiple gets that extended, really small changes can have greatly outsized effects. So that's what happened. If you have any questions, drop them in the comments. Don't forget to hit like, share, and follow me. Thanks.